So how do you invest in whole life insurance? The answer? You don't. It's not an investment. In fact, it's illegal for me to even tell you to do that. So any regulars watching this? Yes, I am saying this. You can't invest in whole life insurance. It's not an investment. It's more like a savings vehicle with a death benefit. It's insurance, right? But there is a cash value component, a tax-free savings account in there that you can actually use for investing, even though you're not investing inside of it and it's not an investment. Here's how. Let me explain why. First off, what is whole life insurance and how does it really work? Because that's the one thing that's been really confusing for a lot of people. We all get term insurance. Term insurance is death insurance, right? You have to die for it to pay out. So your benefit, there isn't one, right? The benefit is for your family, not for you. It covers a basic need, and term insurance is great, especially if you're paycheck to paycheck, money is really tight. It's a good option to protect your family. Whole life insurance is more expensive, right? And whole life insurance is a permanent insurance policy. Because it covers you your whole life, it can be more expensive up front, especially. So with whole life insurance, yes, they have upfront costs. However, as time goes on, the insurance costs get cheaper. This is the opposite of term insurance. Term insurance gets more expensive as time goes on to the point where really you don't want to keep it. Because if you try to keep it for as long as you want, you'll end up paying for more than the death benefit's worth and you'll just cancel it. Which is why insurance companies literally bank on term life insurance. It is their number one profit driver because it's cheap. So lots of people like it because it's cheap. And two, less than 1% of all term insurance policies ever pay out from the insurance companies. That's not because they don't pay them out. It's because you end up canceling before you die. And they even teach you this. They teach you this from day one. They'll say, listen, once you get old enough, you get in your retirement years, stop paying for life insurance. You have enough assets. You'll just live on the assets. You don't need it anymore because people are moved out of your house. You don't need it for your kids. Bull. They're teaching you that because they want to make more profit. That's why they teach it to the insurance agency even to teach you. Whole life insurance covers me for my whole life. And the cool thing is this, guys. A lot of people don't realize this, but with whole life insurance, you can actually pay into it for 7 years and then stop. So you don't have to pay for it your whole life. Traditional whole life, you would. The way we design it with our max ROI infinite banking strategy, we can actually do it to where you make it paid up in 7 or 10 years and pay nothing more, but it's always guaranteed to keep growing that cash value as well as some of the death benefit too. So that's how it works. Whole life covers your whole life. The nice thing is this, is that the death benefit can actually increase as time goes on too. So it's got this inflation hedge, the death benefit, unlike term where it stays fixed for as long as that term is, it does not go up. Whole life goes up in the death benefit. And the one thing I love about it too for the here and now is it has this tax-free savings account called cash value. This tax-free savings account you have in here grows tax-free, can come out tax-free just like a Roth IRA. But the difference is though, guys, is that this money in here is protected. Not only is it protected because it doesn't get taxed, it's protected because it's also guaranteed. It makes guaranteed returns. Also, insurance companies are actually safer than in how they do business than banks. And even if insurance companies do go out of business, which very few ever do, guess what? Those insurance companies have insurance companies that back them up to make sure that your money's protected. So I tell people all the time, like if FDIC only has really roughly 1.5% of all people's savings protected, if 10% of banks fail, I guarantee you're gonna be waiting for your money to get paid back at some point. You don't know where that money's coming from because FDIC doesn't have enough. But with insurance companies, they have insurance companies to back up everything that you have in there. On top of that as well, it's also in most states protected from lawsuits and creditors. In fact, even 100% protected in most cases. That means, guys, that you could have millions of dollars in here, someone sues you and wins, they can garnish anything, including your savings account, but they cannot get to this money. So that's one thing I love about just insurance in general, but whole life, the great thing is that there's not a lot of moving parts. They're roughly paying right now about at least 5 or 6% a year, tax-free is what their total dividends are paying currently. It's awesome. Now, the cash that's in here, here's the big difference, right, guys? This is where max ROI infinite banking differs from traditional whole life insurance or even traditional infinite banking, is that we try to lower the cost as low as they can go. Because the only thing that creates drag, and this is where most of the critics come out about whole life insurance or even infinite banking, because I can already guarantee, probably give some of you guys, I know Astroman, I know you're there because you watch all of our videos. Thank you for commenting, by the way. You're gonna say, no, whole life doesn't make 5 or 6%. And that's true because there's costs coming out. Now it does return 5 or 6% on the cash savings in there. But remember, there's always insurance costs coming out of it. So you might net at least 4 or 5%, at least the way we design it. Others, not so well. But yeah, you will net it. Now, what happens is that cash value grows. The best thing that we can do is if we can lower the costs as low as we can get them, more will go into that cash account that you're paying in. So we actually have people overfund the policy, more than the minimum. We actually lower the minimum as low as we can get and then let you overfund it. So often what we'll do is we'll say, well, what's the max contribution amount you want? And for how long do you want to save it, right? And so what is that amount? And so people might say, well, I could save $30,000 a year. Okay, great. Let's put the max at $20,000 or $25,000 a year, knowing that your minimum might be only about $5,000 a year. And that's what's actually required. So you got this range of like $5,000 to $20,000 or $25,000 you could be putting in, but you're not required to have to put in that $25,000 every year. What's nice though is that because we got that minimum down, more of that cash goes right into that cash value, goes right into that tax-free savings account to start building and compounding and growing. It grows tax-free, and then when you access it down the road, whenever that is, because you don't have to wait till you're 59 and a half to get to it, you can access it tax-free as well. So it's like a Roth IRA, but a lot more freedom to put in more money, less restrictions, no age restrictions, all that kind of stuff, those dumb penalties and whatnot. You're not worrying about that kind of thing. There's another thing you could do too. This is what I personally use my policy for, in addition to, there's really two things I use it for. One for savings, emergency savings, and one for investing. Now, it doesn't mean I have two separate policies. This could be the same policy. But like, for example, my wife wanted $400,000 just sitting in a cash account, just sitting in her bank, earning 0.1%. I don't know about you, but I don't get excited about 0.1% returns. I mean, we already know that inflation is going to kill our money with that, so why would I want it there? So I made an agreement with her. I said, listen, we've got this insurance policy over here with a bunch of cash value in it. What if we earmark $300,000 of this cash value that we don't touch? This is just our emergency fund. We don't invest with it. $300,000 here where it's already making over 5% a year tax-free. And even if we're just making 5%, think of the numbers here, right? $300,000 making 5% tax-free is $15,000 a year. Where before at 0.1% in the bank at $400,000, was making $400 a year, and then I pay taxes. So I might walk away, if I'm lucky, $300 after taxes. So now it's 15 grand versus $300. Which one would you rather have, right? You want the 15 grand. And I still have 100 grand sitting in the bank that we can get to right away. Because it takes me about a week or so to get my money from my insurance. So I have the money in the bank for the quick, easy access money, and then I have the money in the insurance. And I could do any variation. I could say, let's do $350,000 over here, $50,000 in the bank, right? Because I could really justify that too. But that's just kind of the easy numbers to give you. But I make way more money there, so I make more returns, which gives me more money that I could be investing. Because if I make $15,000 more a year, I got extra cash I could actually be utilizing. Now, let's help you understand too, the other side, the investing side. This is not an investment. Whole life is not an investment at all. But I can access the money, I can pull the money out, much like any other savings account, and I can invest it. So this is no different than like a savings account with a bank, although it's with an insurance company and it pays you a lot more than point nothing percent, but it's no different because I can actually pull the money out, either I withdraw it or I borrow it, and then I use that to invest. Now, someone might say, Chris, why would you borrow your own money? Because obviously I have to pay interest. Do I pay interest to myself? No, you don't. You do not pay interest to yourself. You pay it to the insurance company. Well, why would I do that? Because it's not your money. Because here's what they're doing. Let's just say you have $100,000 in cash built up in this policy. What if you want to use $50,000 of it? You could just withdraw the money and invest it. But then your balance of 50 is going to go down to 50,000. You have less interest you're earning. Now, this is even worse if you pull out more. What if you access 90,000 of that 100,000? Now it's down to 10. You're not earning much interest, are you? But the great thing is if I get a line of credit, a loan from the insurance company, I'm using their money. Even if it's a little bit higher interest rate, I can access their money while they're paying me on the full $100,000. So if I pull out 50 from them, my 100,000 is still earning compounding interest tax-free. I use that money to invest. Then I take the returns from that money and I use it to pay down their line of credit. Because as I pay down their loan, guess what happens? I'm not compounding interest on their loan. I have simple interest because I'm paying down the loan, principal and interest. As I do that, guess what? I make more money because I pay them less than what they're paying me on the interest side. You see what I mean there? Like you can actually be earning more in compounding interest here than you pay them in interest, meaning I earn money here, but I'm also earning money on the investment. That's the power. That's where I can make money in two places at once. Now, someone might argue, they're like, yeah, but what if I want to take the cash flow? Great question. I'm glad you asked. When you're in the accumulation phase of your investing experience, you're building up cash. You're taking the returns and then you're reinvesting it to buy more, right? Of course. You're saving it up, you're accumulating it so that you can go and use it to create more cash flow. Same thing here, you're doing the same thing. Once you get to the point where you have more than enough cash flow that you want to be free and stop doing this, great. You make the policy paid up where you pay nothing more in the policy for the rest of your life. It grows guaranteed, by the way, compounding. You can actually pull off tax-free income out of it if you wanted. But the great thing is any loans I might have outstanding get paid off. They're gone when I make it a paid up policy. So then I can take all of my cash flow still, and I still have cash in the policy that can be used for whatever I want later on. That's the beauty of it. That's how you can actually get money to pay you in two places at once. So although it's not an investment, remember, whole life insurance, you don't invest in whole life insurance. You save in it to then you can later use that money to invest in other things earn money in two places at once, allowing you to compound and grow more money faster so you have more money to invest and potentially shaving off years towards your retirement or your passive income goals that you have there. Now, naturally, everybody always says, yeah, but what does this look like? How does it look for me? Like, you're not showing me numbers. You're right, because you're all different. So the best way to do that is go to moneyripples.com, click on the infinite banking section. You can actually book a call to actually see from our actual infinite banking specialist to see what does that look like for you? How does it actually work? You can see the real numbers on a Zoom call right there. Just go to moneyripples.com, click on infinite banking and book your call now.